Hello, this is Options Basics Part 1. This is the first part in a series of several online tutorials for people to learn about options and different types of strategies that can be implemented into anyone's portfolio. This first one, though, I'm going to be just going over a little bit of the history of options and some terminology that's going to be used throughout the tutorials, the webinars, and my online classes. So if you are new to options, this is going to be very beneficial to you. You're going to probably want to take a little bit of notes so that you can memorize some of these different terminologies that we're going to be using throughout. If you are an options trader or a beginning options trader, you might want to move a little bit further in this series and find some of the strategies that can be implemented into your trading portfolios. So my name is Eric Wilkinson, and many of you may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented in those publications from everything from geopolitical to economic and market analysis. A little bit about me: I've been trading my own money for about 20 years now, a little bit over 20 years, and just want you to know that this is an educational company. So anything that I talk about in this is for your educational purposes. My main goal is really to be able to get you guys to be able to take control of your finances and your retirement accounts. You don't really have to have somebody else doing this work for you. You could be doing it for yourself in 15-20 minutes a day. Most people spend more time planning a vacation than they do planning for their retirement, believe it or not. So just keep in mind, going through, I'm just here to help you take control. I'm not here to tell you that I'm going to make you rich, that I'm going to make you a millionaire, but I'm going to help you manage your portfolio and to manage your own risk. I'm going to teach you different types of rules to implement into your trading strategies and when to get in and when you should get out of these different types of trades. Like I said, I've traded in most markets throughout my career. Being on the floor of the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products throughout my 20-plus year history. I got to go over a little bit of housekeeping here. This disclaimer really talks about how in these video tutorials, I'm not going to be implementing any strategies, because if I were to do that and you watch this video 2-3 years down the road, or even 2 days later, the strategy might not be appropriate for the market conditions. So anything I talk about here is going to be a little bit more hypothetical and how you could come up with your own strategies. This disclaimer goes on to say that anything I talk about cannot be construed as investment advice. The bottom line is you need to do your own homework. We are here to help facilitate your learning. I'm not here to give you trades and tell you how to trade, because I don't know your risk parameters. I don't know what's in your portfolio. I don't know what you like to trade. So at the end of the day, do your own trading and do your own homework. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. I'm sure you guys have all heard that before. But this brings us to the history of options. Started over 2,000 years ago, believe it or not. And I'm going to try and go over this in several seconds. It may take a little bit, but I think it's very important to kind of learn our roots. This is Deleuze from Miletus, and he's the earliest recorded example of options. And he was referred to in a book by Aristotle called Politics. And he kind of talks about an account of Deleuze and how he became a very wealthy man and profited from options. And it wasn't really known as options back then, but Deleuze was a philosopher. And he also had other interests in astronomy and mathematics. And he kind of combined all of these knowledges of the different subjects to create what is effectively known as options today. Deleuze managed to predict that there would be a vast harvest in olives in Greece in the spring. So he went to all of the olive presses in the area and started contracts with these different olive press owners. He didn't have a lot of money. He didn't have enough money to build his own olive press. He didn't have enough money to buy all of these olive presses. But what he effectively did was entered into contracts with these owners and kind of cornered the market, knowing that at the end, or at least believing at the end of the season, there was going to be a huge harvest in olives and everybody was going to need his services. So after signing all of these contracts, of course, at the end of the year, there was a huge harvest in olives. And everybody had to come to Belize to process their different olives. So he ended up selling off his contracts to the people that needed them the most, and it made him a windfall of money. This is the basic principle for how we know calls today. Now we have other financial instruments such as equities, commodities, and other underlying securities instead of olive presses, but the principle still remains the same. Then we move on to the Tulip Bulb Mania of the 17th century. Anybody who's studied the markets or studied economics has heard about the tulip bulbs in Holland in the 17th century and how it really created a disaster for the economy. So this is another relevant occurrence in history of options in the 17th century. The reason being is a lot of people that didn't have the money to actually buy these bulbs when the bubble was starting to happen started using options. The real rub was these options weren't standardized, and people that were farmers and not really the wealthy aristocrats were able to get in on this market through the use of options. But as the bubble was happening and the prices began to rise, it was kind of unsustainable. And as we all know, when buyers start to disappear and the prices begin to plummet, many of those that had risked everything, some of these farmers put up their houses, took all their savings, put it into the market, were completely wiped out. Ordinary people had lost all of their money and their homes, which caused the Dutch economy, as we all know, to go into a recession. But the real thing that happened here was that due to the unregulated options market, there was no way to force an investor to fulfill their obligations on the options contracts. And this ultimately led to options gaining a bad reputation. So the evolution of options. We're moving on to the Chicago Board of Trade. And in 1968, the Board of Directors of the Chicago Board of Trade started to look at ways to grow their own business. The futures and commodities were starting to slow down a bit. So they wanted to figure out a way to increase their overall margins. So in 1973, the Chicago Board of Options Exchange began. It was the first time options contracts were properly standardized and there was a fair market value for them to be traded. At the same time, the Options Clearing Corporation was established for centralized clearing and ensuring a proper fulfillment of the contracts. This was a huge step in the options history because before it was kind of a contract and there was nobody outside or a third party that would force one party to honor their contract. So over 2,000 years after Belize had effectively created the first call, trading of options was finally legitimate. When the CBOE opened for trading, there were very few contracts listed and there was only calls because puts hadn't been standardized at this point. There was also some resistance, largely due to the difficulties in determining whether there was a value here. But in the same year, 1973, two professors, Fisher Black and Myron Scholes, conceived a mathematical formula that could calculate the price of options using specified variables. This formula became known as what we know today as the Black-Scholes pricing model. And it had a major impact as the investors began to feel a little bit more comfortable about options trading. In 1977, puts were also introduced to the exchange, and a number of stocks which options couldn't be traded was increased, and the liquidity of these contracts traded continued to grow. Towards the end of the 20th century, as we know, online trading has been gaining in popularity and trading many different financial instruments vastly more accessible for members of the public all over the world. This has created huge liquidity and made these instruments very popular. In the modern options market, there are thousands of contracts listed on the exchange and many millions of contracts traded every day. Options trading continues to grow in popularity and shows no sign whatsoever of slowing down. So that's why this is really important for you all to get involved in options.